In this video, we'll be talking about what happened with the central bank's week last week, where they have a lot of announcement and different meetings from all the different central banks. These are the topics we'll be going over today. First of all, we'll have the Fed, then we'll talk about the ECB, then we'll talk about Bank of England, Bank of Brazil, and then a little bit of chicken or the egg, what comes first, and then finally cover up with the market update. First off, with the Fed announced a 25 basis point hike as market expected. It stated future rate increases, so in the initial publishing, that in future increases would be appropriate, and they do not expect any rate cuts in this year. But later on, in the press conference, Powell mentioned that they'll consider the cumulative effects of rate hikes and also talked about disinflation. And from that point on, that's when the market really took off for Wednesday and also into Thursday before the jobs report. And he also mentioned the dot plots where the FOMC members will think about where the eventual rate will be. It was not updated in the January meeting, and they will do so in the March meeting. So that kind of puts a little bit more emphasis on the March meeting. And market interpretation was that they expect 2 more rate hikes, maybe another 25 in March, another 25, one more. But then starting from September, there will be 4 rate cuts in 2023. So this is a big gamble that the market is betting on, and we'll see if that is the case. In my opinion, I do think rate cuts are coming, but until we have a liquidity financial crisis, I don't see that happening. So the fact that the market is trying to front run that is pushing that possibility further and further down the road. With the ECB, so the ECB came out a little more hawkish than the Fed, 50 basis point rate hike, which makes sense because they are like one of the more later central banks to hike rates. When asked about the March plan rate hike, if that will be the last, Christine Lagarde, Madame Lagarde, said no. Whatever rates are needed, to deliver on their 2% inflation target in a timely manner. So she really came out really hawkish, stating that March hike is already intended for another 50 basis point hike. That's much different than what Powell was doing. He didn't mention what the next rate hike will be. He just mentioned, hey, future increases are anticipated, where Madame Lagarde stated that, hey, the next one will be 50. So market interpretation, they anticipated peak rates to be 3.33 to 3.28, and the first, so they anticipated with the peak rates kind of fell down actually. So meaning they were anticipating 3.33 to be the peak, but now it got moved down to 3.28. And then the first rate cut, it got moved from November 2023 to September 2023. So meaning the market continues to call the bluff on ECB, thinking that they'll provide liquidity, before anything happens, much sooner. So again, we'll continue to see if that will be the case. For Bank of England, so again, 50 basis point hike as the market expected. However, Bailey did provide something that was a little bit different, where he's seeing the first signs of inflation turning the corner. But he also, so they're really talking on both sides of their mouth, where he's saying there's still a long way to go before cost of living is brought under control. But he does, again, both sides. He is seeing a much shallower recession than they feared. So again, the soft landing fantasy. And the market interpreted that to be, even though that Bank of England is saying that inflation will be sticky for a while, but they don't expect a recession, if any, and if any, it won't be bad. And so they continue to call the bluff on BOE, thinking that again they'll provide liquidity before anything happens. So a lot of the market participants are not expecting these central banks to remain strong to deal with inflation or whatever they're fighting, but rather they'll provide liquidity and also cut rates much sooner than the central banks are claiming. So again, we'll see if that is the case. With the Central Bank of Brazil, this is actually interesting. So they maintain their rate for the fourth meeting, so for fourth time. So they're not cutting rates at all. Even though inflation rate is much lower than their bank rate, and so this is the thing. Is Brazil an example that central banks cannot cut rates sooner? So meaning they don't have to keep hiking rates, but they just maintain a higher rate in order to really control inflation, to really kill it. And a lot of markets are expecting right now that ECB, Fed, Bank of England, they'll start cutting rates immediately after ending the last hike. But what is the possibility that these central banks will just maintain the rate high for a much longer period of time than the market is expecting? So the real for Bank of Brazil, the strength on the real is not benefiting Brazilian farmers, since commodities like sugar is priced in US dollar. The strength in the real causes domestic sugar prices to fall because the weakness in the US dollar in comparison to the real, and that is removing incentive for sugar farmers to increase supply, and hence we're seeing some commodities rally. And the question is then, ignoring what the Fed is doing with the US dollar, will Central Bank of Brazil be the first one to cut rates in order to influence its currency to make it weaker? And will this be a sign that other central banks will only cut rates if their currency gets too strong? So again, this is another kind of sign we can look around. If the currencies for a set country is not strong yet, then there might be not enough incentive for them to cut rates. And another thing is, US dollar has to be strong in order to avoid, commodity rally returning. So again, the chicken or the egg. So when we take a look at the rate history for the Fed, rate hikes comes after seeing inflation. They're late on it. They don't do it early enough to prevent it from happening, because what happens is inflation acts as a lag. We have the monetary increase, monetary base increase, and hit with a supply constraint, then you have inflation brewing. But the problem is it happens in a lag. But if central banks were able to hike rates sooner, then you avoid that. But obviously, again, they always act on the they're always late to do so, and so we see rate hikes come after seeing inflation. But when do we see rate cuts? We only really see it after financial crisis has occurred and not deflation. So what the market needs to understand is, just because we're seeing disinflation or inflation, slowing down, doesn't mean rate cuts are coming. We need to see that liquidity crisis. We need to see financial market crisis before we expect any rate cuts. And the market is trying to front run those anticipated rate cuts by buying. They buy more when bad news comes out, thinking that means the Fed will come to the rescue sooner. So when we see all these companies reporting bad earnings, laying off workers, market is still buying, propping up these financial asset prices. And that's the problem. The more they try to front run these rate cuts, the later these rate cuts will actually come. so again, the chicken and the egg, right? Which comes first? And the market is not understanding that part. While the economy continues to weaken, bad earnings continue to come. There will be a reckoning because someone has to eventually say, you know what, no more. The Fed's not easing as early as we're expecting. We can't keep buying these, bad earnings, bad companies, and it has to like all these things have to fall. Like the prices have to fall before the Fed comes to the rescue, and taking a notice, like we're seeing, US dollar and finally gold is sniffing out, further tightening to come. Oil front ran the downside, and so there is a possibility that oil can rally along the dollar because we saw oil front run this downside much sooner than gold, while gold stays strong right up until Friday when the jobs report came out, and U.S. dollar also turning a corner on the DXY. And equities, however, still have a lot to play catch up, and this is very dangerous. Some future catalysts might have to be more hot jobs data or CPI coming out next week, or the FOMC March meeting when we see the dot plots as well. So market update, let's take a look at the jobs data on Friday. So we had it 517,000 jobs versus the 188 expected. That is a big miss in terms of market expectation. And honestly, I think market expectation, like in my opinion, market expectation is probably correct, because it makes no sense when you consider how many companies are slowing down hiring and some even laying off workers, and more to come. And corporate profits are also falling. Like, what the jobs data is signaling is that there's no such thing as a soft landing or hard landing. There's no landing at all. And that US economy is still going strong and there's no slowdown at all. But if we take a look at corporate profits, we take a look at hiring, that is not the case at all. And if somehow this jobs data is true, or at least the Fed is following and trusting this data, they will not be loosening anytime soon. So we'll see if with Fed Chair Powell speaking tomorrow, we'll see if he walks back a little bit of his FOMC comments, be a little bit more hawkish, and along with this jobs data coming out. The DXY, as expected, the long-awaited oversold rally has occurred, and my target continues to be 106 to 110. It might overshoot to 110 before rolling over to the 90s. So again, I'm expecting the DXY to rally, and that will provide the opportunity to buy, things like precious metals, and expected, with gold. For the DXY rally, gold is pulling back. It's just starting, and my target is continue to be 70.50 to 1800s. We'll see if that fully pull through. Equities, here's the tricky thing: if the DXY erased all of its post FOMC losses on Wednesday and Thursday, and is rallied, now over 103. Should the Nasdaq and S&P reverse all their gains post FOMC? So we'll see if that is the case. Maybe they need a catalyst. Maybe Powell speaking tomorrow, or we have to wait until a CPI if it comes out hot. We'll see. But going forward, with the corporate earnings falling, but wage inflation continues, as we're seeing, the wage increases from jobs data because of a really tight labor market, and consumers continues to be squeezed by both, expenses increasing with inflation, while some people are actually losing their income with layoffs, and they're already stretched out thin with we're seeing massive credit card debt. All of these along with a Fed tightening policy, is a recipe for a much bigger collapse in the financial market. And let's see if that will fully play out. But in my opinion, until we see a liquidity crisis, the Fed has to continue this path. And thanks for watching.